Good morning, ladies and gentlemen. Welcome to our corporate and tax webinar, where we will be discussing the hot topics and recent trends that we saw over the past year in mergers and acquisitions. Of course, as everybody knows, it's been a very eventful year last year, and at the beginning of the pandemic, during the first lockdown, we as a firm, we made a few predictions. We also sent a few newsletters in that respect at the time about how we would see M&A activity in the year to come, in 2020. And a year down the road, I think we can say that a number of those predictions turned out to be true. But on the other hand, and luckily enough, a number of the predictions we made turned out not to be correct. And of course, one of the most important, I would say, negative predictions we made is that we did fear that there would be a substantial impact on M&A activity, on deal flow in 2020. And although it cannot be denied that there was a downturn in the second quarter of 2020, a lot of deals were put on hold, not so many aborted, but a lot of deals were put on hold. No new deals were coming in those first months. We did see that in the third and fourth quarter of 2020, that the deal flow picked up substantially, and we were back at levels of the year before by the end of last year. We also see that in the first quarter of this year, the deal flow is still very positive and it's looking very good. The pipeline is very good. Of course, what the long-term impact will be, that is still a question mark. A number of other of those predictions that we made did turn out to be true. We did think that Corona would have an impact on how deals were structured, and in particular on the pricing mechanism. And my colleague Florence Colpaert will go into further detail on that in a few minutes. And we also did predict that to a certain extent, the focus in our due diligence on target companies would be put in particular on COVID and Brexit measures, and that also turned out to be true. As far as the agenda of this webinar is concerned, I forgot to actually introduce myself. I'm of course Peter de Rijk. I'm a partner in the corporate and finance department. So just after this introduction, I will pass the floor to my colleague Florence Colpaert, who is counsel in our corporate and M&A team. And she will be speaking particularly of the impact on M&A, in particular the negotiation phase and the pricing. And she will also address certain structuring issues and also certain possibilities offered, in particular by the new Belgian Companies Code. After that, I will come back to address the due diligence issues. And after my presentation, I will pass the floor to my tax partner, Geert de Neef, who will also address two particular new tax issues, one being the Reconstitution Reserve, which is actually something new, which was introduced by the law of 19 November 2020 to address the impact of Corona. And secondly, he will also talk about debt forgiveness. During this presentation, you will have the opportunity to take part in two poll questions. One poll question will be after my presentation on due diligence, and the second one will be after the tax presentation. And lastly, during this introduction, I will just point your attention to a few practical issues. You have the possibility to download the presentation by clicking on the right side, the right bottom side under handouts. There you will find the presentation to be downloaded. After the webinar, you will also receive a certificate of attendance by GoToWebinar, who hosts this presentation. And of course, during the webinar itself, you can also ask a number of questions through the chat function. To the extent that we have sufficient time, we will address them during the webinar. If not, we will certainly get back to you by email regarding your questions. So that's all as far as the introduction is concerned. I'm happy to pass the floor now to my colleague, Florence Colbart. Thank you.
Thank you, Peter. Good morning, everyone. I hope that everybody could join in the meantime. So today I will present some recent trends in M&A. Let's start with the negotiation phase. Of course, it's impossible to talk about recent trends without talking about COVID-19. Despite hitting us more than a year ago now, it's still there, still very present, and it still influences the deal-making process, at least to a certain extent. In the first wave, the outbreak of the pandemic, the burning question regarding MAC clauses was whether existing clauses could be used by buyers to walk away from the deal or to renegotiate the conditions on the basis of the pandemic. This led to a lot of litigation. Some of them are very famous. You may know about the takeover of Tiffany by LVMH. Initially, in the first quarter of 2020, further to the outbreak of the pandemic, LVMH tried to walk away from the deal. This led to some litigation in the US. The parties then went back to the negotiation table and agreed on a decrease of the purchase price at the end of 2020, and they recently closed the transaction in January 2021. So we do see that MAC clauses are not always successful in walking away from the deal entirely, but they are a good element to go back to the negotiation table to renegotiate better conditions for the buyer. Currently, the question is still relevant. COVID is still there. We're in the second or the third wave. There are variants of the virus. So in certain sectors, it's still a very present threat. So, however, the question is no longer, is it a foreseeable or foreseen event? And no, the question is, do we want to exclude or specifically include this threat as a MAC or as a material event? So that will have to be carefully drafted in the negotiation, of course. We do see also that COVID-19 has influenced the structure of the purchase price itself. So in businesses heavily impacted by the pandemic, such as hotels, tourism in general, aviation, the pre-COVID valuation is now completely out of proportion with the current value of the business. So sellers try to obtain an earnout in order to benefit from the future positive development of the business and hopefully upon the return to normality, if that ever happens, of course. But this entails certain risks, as you know, risk of manipulation of the numbers that are used as a basis, risks of legal disputes. So in any case, the duration and the thresholds that are used in the earnout clause should be carefully thought through and negotiated and drafted. With respect to the purchase price calculation itself, it basically comes down to how the parties approach uncertainty. So in pre-COVID times, we noticed that parties would usually prioritize certainty about the price, so with lockbox mechanisms. In COVID times, we do see a trend that parties privilege value certainty through the true-up of closing accounts, where the price is actually only finalized on closing and post-closing. This will, of course, depend on the sectors. And in the seller's market, such as for auctions, there we see that parties still use lockbox mechanisms in any case. Also because closing accounts have some disadvantages in terms of resources and money involved for the review thereof, and there's always an increased risk of disputes as well, of course, post-closing. At the outbreak of the pandemic, we thought that travel restrictions and restrictions on gatherings would hinder the deal flow, and like Peter mentioned, site visits were impossible, negotiation meetings would be difficult. I think while we all miss clearly physical meetings and the proper closing meetings, we did see that parties got used to remote meetings and negotiations, and except for an initial pause in the spring of 2020, the second half of 2020 was as busy as it has ever been for us. With respect to the structuring of an acquisition vehicle in Belgium, I would like to mention a couple of points. The recent Code of Companies and Associations made the BV, which was initially used for smaller entities, smaller businesses, they made it a valid alternative for also larger businesses. For example, there used to be numerous clauses on the types of instruments that could be issued by the BV, and this is no longer the case. However, we do see that NVs are still pretty much used, especially in larger deals. That's partially out of habit, of course, but also because the NV does offer some greater flexibility. And so I will present two of these advantages with respect to the NV. A first example concerns dividend distributions. So in an NV, you have a classic net assets test, which means that the net assets of the company cannot be or become further to the distribution lower than its share capital. So that was a pre-existing test in Belgium. This test also applies to the BV. However, in the BV, you have an additional liquidity test whereby the management body has to confirm that the company can continue to pay its debts as they fall due in the coming 12 months following the distribution. So it's an additional liability that the management of the BV has to take with respect to dividend distribution. So that's definitely something to take into account. A second example concerns the management body of the BV and the NV. So in the new system that we have now, the NV offers the greatest flexibility in respect of management bodies. So you can opt for a single director, just one person, legal entity or physical person. You can opt for a classic one-tier board, like we had in the past, or you can opt for a two-tier board, meaning you have a management board and a supervisory board. While a two-tier board is not really yet so much used in Belgium, especially for Belgian non-listed entities, we do see that investors, especially private equity investors, in particular from France and Germany, are used to this system, they know it, and they like to implement it in their Belgian participation as well. There are a couple of points of attention in that respect. So the management board is in charge of obviously the operations of the company. It also has some all the residual powers that are not attributed to the supervisory board. And then the supervisory board, of course, supervises the management board. It's in charge of the general policy and strategy of the company. And it also has the specific competences that are attributed to it by the company's code, for example, in terms of reporting, in case of capital increases and things like that. One item that proves to be tricky in practice is the fact that members of one board cannot sit in the other board. And so this can be particularly a hurdle for the CEO of the company. The CEO has to be in the management board. That's what makes the most sense. But it means it cannot be on the supervisory board, which actually decides on the general policy and strategy of the company. For the private equity investor, it can also prove tricky because they will want to sit at the supervisory board, but it means they cannot be involved in the management, and there needs to be a bit of a mind switch in how parties are working, or the two bodies are working together. For this last item, the competencies of each board, the solution is that the articles of association of the company can provide that certain operational decisions of a certain importance, for example, above a certain threshold, are escalated to the supervisory board. And so that would enable, for example, the private equity investor who's not on the management board and only in the supervisory board to still have a level of control, if you like, on certain important decisions. So that has to be carefully thought through depending on what the parties want. The BV, on the other hand, offers a more limited choice in terms of management body, because you can opt for a sole director, multiple directors, or a collegial body board of directors. So that's more classic. And then finally, I will say a few words with respect to post-acquisition formalities. UBO, so ultimate beneficial owner formalities, are now more strict in Belgium. First of all, because you have to provide evidencing documents next to the UBO declaration, which means that often you will have to upload the share register, which is a private document, into the UBO register platform. So that's can prove a little bit annoying. And then secondly, fines now also apply not only to the company for not filling out the UBO declaration, but also to the beneficial owners themselves if they do not provide the information to the company. And then last point I wanted to mention concerns sole shareholding in the BV and the NV. So in the past, we had a joint liability of the sole shareholder for the debts of the company if he remains the sole shareholder for more than 1 year. That no longer exists, so that's not an issue. We see lots of clients want to simplify the structure of their groups because you had one share often in another entity. So they want to streamline this, not a problem at all, but know that the identity of the sole shareholder has to be recorded and kept in the company's file at the clerk's office. So it's not published itself, but it can be consulted. So there is a certain degree of publicity. All right, thank you for your attention. That was all for me. I will now leave the floor to Peter, who will update you on recent trends in due diligence. Thank you.
Thank you, Florence, for your presentation. As mentioned, I will address the matters that we encountered last year in the framework of our due diligence exercises. It is, of course, obvious that our clients asked us to pay particular attention to matters that involved Corona and Brexit, and to see how that impacted target companies. And of course, I will address those. But apart from that, irrespective of those two important events, we did see a number of other issues that were either new or relatively new in the years before, and that we saw that became very material in the last year. As far as COVID-19 is concerned, of course, obviously, we were asked to check how resilient the target companies were from a legal point of view to face the pandemic and its consequences. And of course, the first thing we checked in detail were the material contracts that were entered into by the target company with their clients and suppliers. And in first instance, we checked whether under those contracts, based on MAC clauses or other clauses in the contracts, whether target companies were either still able to perform these contracts or alternatively suspend or even terminate the contracts without risking too much liabilities or too high penalties. At the same time, that was at target level. We also had to check that at supplier level and client level, of course, because you want to avoid that you're under obligation to perform towards a client and that your suppliers have terminated their contract and vice versa. You also want to avoid situations where you have to respect your contracts with your suppliers, but the clients just walk away and or don't pay their invoices. So that was, of course, an important check that we had to do in detail in those contracts to always have both Corona and then go on to it later in the back of our heads when reviewing those contracts, and also specifically ask certain questions in that respect also in our standard due diligence questionnaires. We, of course, also checked from a legal point of view the supply chain. Were there enough alternative suppliers in case one or more suppliers would terminate their contracts? And of course, we also checked possible legal solvency issues that the targets could face themselves or as far as their suppliers and clients were concerned. Another important thing we had to check is whether the target companies complied with all the, I would say, measures or support measures that were offered in the framework of Corona by the government. Did we see perhaps a non-compliance of those support measures, of an abuse of those support measures? Do we see a risk of the fact that those support measures would be retracted, or even certain support would have to be repaid or reimbursed? Or do we see potential penalties? One of the typical support measures was temporary unemployment. Did the company comply with the legislation on temporary unemployment, or were there additional risks in that respect? And again, in our due diligence questionnaire and in the Q&A organized, we did ask quite a lot of questions in that respect. And finally, another matter that we focused on specifically as a result of Corona was the insurance coverage of the target entities. And in particular, this year, we focused a lot on whether or not the target entities had entered into a business interruption insurance policy, and of course, what the terms of that policy were, so that in case of a complete downturn, perhaps there could be some coverage in that respect from the insurance companies. As far as Brexit was concerned, again, a few matters that we focused on the last year. One obviously being whether or not certain material contracts had clauses which contained a territorial scope. Obviously, the UK is no longer part of the EU, and so we had to check whether there were clauses in agreements which referred to specifically, for instance, the EU as a territory, for instance, in the framework of non-compete clauses, or in the framework of clauses where you would engage not to enter into a certain business. And of course, it is very important that if those clauses would refer to the EU, that our client, the potential purchaser of a target, would be aware that as from the beginning of this year, this would no longer cover the UK. So potentially a competitor could start competing with your business in the UK if you just use this generic EU term. Obviously, it would have been better if the country had been named specifically the UK, or even if you would refer to Europe as a territory rather than the EU as an organization. Also, of course, in the framework of Brexit, we checked the material adverse change, force majeure clauses, whether or not this could be invoked by the target or by customers or suppliers to no longer comply with their contractual obligations. I think this is certainly a matter more for the past. Of course, Brexit now is done. It does not longer apply into the future. It should have been invoked if they had the chance to invoke it last year. Another important matter for clients and targets to realize is that, of course, as from this year, the UK legislation, laws in certain specific sensitive areas, important areas, could differ from now on completely with the laws that were in effect in the EU up to now, and which to a large extent would have been harmonized. Of course, obviously, taxes is one matter, social security, but also in particular, laws concerning health and safety, concerning product liability. You have to realize that when a target operates in the UK, there will be a new set of laws that may need to adhere to. May be likely that they will be less strict than EU laws, but still something to watch out for. A very important matter that I will also address in a few minutes, because it's not necessarily related to Brexit, but it also is impacted by Brexit, is the whole Gdpr legislation, and in particular the prohibition to transfer private information outside Europe. As you know, there is a general prohibition that sensitive private information would be transferred outside Europe, except for those countries with which Europe has entered into a bilateral agreement. This is what we call the privacy shield. Currently, there are about 11 countries outside Europe to whom you can send private information lawfully without being in breach of GDPR. These countries include countries like Switzerland, like Israel. They included until last year also the USA, but that is no longer the case. That has been suspended. Now, of course, now that the UK is outside the EU, In theory, they no longer fall under this privacy shield, although a grace period has been agreed until the end of June 2021, which means that in a few months, there is a risk that you can no longer send private information to UK companies, to software companies, to suppliers, to clients, unless, of course, this grace period would be extended or effectively a new bilateral agreement would be entered into. But it is, of course, also a point of attention in the framework of Brexit. Finally, as mentioned, there are some topics that we came across last year in due diligence, which are not specifically related to Corona and Brexit, but which I think are also important and worthwhile mentioning. The first one is more of a company law topic. You all know that Belgian companies have until January 2024 to adopt their articles of association to the new companies code. So that's a point of attention that we have to focus on more and more as we are approaching that end date. But at the same time, and as Florence already explained, the new companies code offers a lot of opportunities in terms of structuring deals and management of companies. So certainly it's also perhaps advisable to look at companies that have already implemented that new code, or perhaps to do so in the near future. I mentioned GDPR in the framework of data transfers to the UK within Brexit, but GDPR has effectively become, in our view, a very important topic, not only for sectors that are typically affected by that and process a lot of private information, such as banks, insurance companies, healthcare companies, but in general, in all sectors and with all target companies, we see that very often we have an issue here. And the reality is that we see more and more, and this is very recent, that local data protection authorities are becoming much more proactive in their controls and in also effectively applying penalties. And you will probably have heard that these penalties can be substantial. Penalties can go up to 2 to 4% of the worldwide turnover of the company concerned. And this is not just, these are not just theoretical penalties. Some penalties have already been issued to companies in enormous amounts. The French Data Protection Authority fined Google for 100 million euro. They fined Amazon for 35 million euro. But it's not only US companies, even the British Data Protection Authority issued a fine to British Airways in excess of 20 million euros. British Airways being one of the national prides of the UK, of course, so that was a substantial fine. And just recently, it was in the news, the Spanish Data Protection Authority fined the Spanish bank, CaixaBank, with 6 to 8 million euros. So it's not purely theoretical. In Belgium, these large fines have not yet been issued, although Proximus, I believe, has already received a fine of 50,000 euros. But it is an important issue, and we see that the legislation on GDPR is very complex, is very extensive, and we see, unfortunately, very few target companies that are in complete compliance with GDPR. Another important change in the last year, which also becomes a focus of attention in due diligence, is the new law of 1 December 2020 on unlawful terms, abusive terms in B2B contracts. As you know already, for many years, there is a protection of consumers in B2C relationships on abusive terms, on unlawful terms. But since the end of last year, we also have a relatively strict legislation on B2B contracts to protect smaller businesses against dominant positions, abusive clauses imposed by big multinational companies or other companies. So there, again, an important focus of attention. Employment matters are, of course, always a point of attention. We always see the usual risks coming back. Some new risks that we have seen sometimes relate indeed again to those Corona support measures. I mentioned before the temporary unemployment measures, and we have to make sure that the target companies are compliant therewith. What we also see coming back is risk of underfunding in defined contribution pension plans. More and more, of course, for a defined contribution plan, an employer only has to, transfer a certain amount, a defined amount, into the pension plan of the employee. But there still is a legal minimum return that has to be met. And this legal minimum return today is at 1.75%. And we see a lot of pension plans that until a few years ago were pretty safe in the sense that this return could be easily met. But the last few years, that has become more difficult. Of course, the test is only at the end of the pension plan when the person retires. But today we see a risk of underfunding becoming more important. And finally, in employment matters, just perhaps a little bit of a word of warning. We see in our neighboring countries more and more companies which are called professional employer organizations, PEOs, offering their services. These are companies, specific companies, that just basically, take over the personnel of a given company and then immediately put them back at the disposal of the target company. And it's much more limited than a typical outsourcing company. Here, these are really special purpose companies that do nothing else than just take on board employees of various entities in various sectors and then put them back at the disposal. This today is illegal in Belgium. This is unlawful putting at the disposal. And we see, or what we fear, is that target companies may be approached by these kind of companies. And so there is a little bit of a word of warning that we should be very careful thereof. Finally, of course, and as always, tax is a very important matter in due diligence. My colleague Geert de Neef, our tax partner, will discuss a few hot tax issues in just a few minutes. So that's as far as my presentation is concerned. What we do have is, as mentioned before, is a very short poll question that we'd like to ask you. We'd like to find out with you what you think will be the principal legal risks, of course, and liabilities facing a company in 2021. I mentioned the main risks we saw last year. Do you believe that some of these risks, such as COVID-19 and Brexit, will continue to be an issue from a legal point of view, of course, for businesses in 2021, or do you think the focus will be elsewhere? So we'll start our poll now. It will last for about 30 seconds, and we can then look at what the results are. Okay, we have the results of the poll. I believe we can share these results, and we see that still there is a quite large majority of people that still think that COVID-19 will also, from a legal point of view, continue to be a very important risk for companies in 2021, together with GDPR as number 2, and Brexit being less of an issue. So that's an interesting result. I think indeed the worst case scenario of Brexit has occurred, and probably most companies are relatively well prepared, at least from a legal point of view, for Brexit. Of course, the whole uncertainty governing COVID-19 continues to be an issue. I'm surprised by the low percentage for tax, because tax continues, of course, to be a very important issue in due diligence, but of course, perhaps not something which will be more of an issue in 2021 than previous years. But in any case, thank you very much for participating to this poll. As mentioned, I will now pass the floor to my tax partner, who will discuss 2 particular tax hot topics of the last year. Thank you.
Good morning. I am Geert de Neef. I would first like to thank Peter and Florence for these clear contributions that they have made on corporate M&A topics. I will deal with two topics which are, from our perspective, from a tax perspective, quite relevant in recent M&A and restructuring transactions. So I will discuss with you the Reconstruction Reserve, which is a new tax measure, as well as various tax aspects related to debt forgiveness, something we encounter often in M&A and restructuring operations. At the end, I will also present a poll question to you. It will be a technical question, but given the brilliant audience we are having today, I'm sure that everybody will pass this little test with flying colors. So let's kick off. The Reconstitution Reserve, this is a very technical part, like many things in tax are very technical. What is it actually? Well, it is a specific tax measure which is adopted in order to increase the solvability and the cash flow position of corporate taxpayers. So it's a COVID-19 measure. It's actually a deferral. It's protection of cash savings of companies. It's actually a deferral of corporate taxation. Now, the Reconstitution Reserve, I will use the name RR to make it a little bit more human language-like, even though RR. But the RR applies to all corporate taxpayers or foreign taxpayers which are subject to the non-residence corporate tax regime. So it's foreign companies having a permanent establishment in Belgium. So it's not like many other measures limited to small companies. It applies to small, medium, large companies, etc. Like always, there are, of course, some companies which are excluded from the Reconstitution Reserve. Why is that? Well, because they are already subject to a specific favorable tax regime. So it's certain types of investment companies and regulated real estate companies. Also, companies which are to be considered as distressed are not qualifying for the Reconstitution Reserve. And also companies which have since March 12, 2020 carried out certain, I would say, cash out transactions such as repurchase of shares, distribution of dividends, or of a liquidation reserve, or who have proceeded with a capital, share capital, or an equity distribution are excluded from the Reconstitution Reserve because they are already or subject to a favorable tax regime, or the aim of the measure, which is to increase the cash level of the companies, has not been, how would I say, has not been followed or respected by these companies. So that's the basic mechanism. The RR, how does it work concretely? It's actually a tax-exempt reserve, which is established by a qualifying taxpayer, so somebody who is not one of the disqualified taxpayers, at the end of a taxable period, which is connected to one of the tax years 2022, 23, or 24. So if the Reconstitution Reserve is established, it does not necessarily end at the end of any of such years, but it needs to be established at the end of any of such years. So for 2025, no Reconstitution Reserve can be newly established on the basis of the present legislation. Any existing one will still apply in any year following the years you are watching here on the slides. When the Reconstitution Reserve is established, it's also limited to the amount of the taxable reserved profit. So there is no negative balance possible in any year. You will look every year at the increase of your taxable reserves. That is the basis for your corporate taxation base, and it's up to that amount, maximum that amount, that you can establish for that year the Reconstitution Reserve. Moreover, the Reconstitution Reserve is also limited to the accounting operating loss over the financial year ending in 2020. So your financial year, which ends in 2020, needs to have an accounting operational loss. Otherwise, no Reconstitution Reserves for any of 2022, 23, or 24 can be established. So it's important, it's your accounting loss and not your tax loss. Certain costs are accounting-wise deductible, but are not tax-wise deductible. So that's something one should bear in mind. And also there is a maximum nominative cap of nominal cap of 20 million euros, which cannot be exceeded. So basically, you take the operating loss of 2020, and the total amount can be spread out over the years 2022, 23, or 24. And for those years, a non-taxable reconstitution reserve can be established. The reconstitution reserve, of course, there are also some basic conditions. It needs to be recorded on one or more liabilities accounts, which are non-disposable for distribution. Also, companies which have a direct participation in a tax haven company or who carry out non-justified payments for more than 100,000 euros per year are disqualified. And the reconstitution reserve becomes taxable after you have established it. It still becomes taxable in case any of the following operations is carried out, and to the extent of such operations. So you read there: repurchase of shares, dividend or liquidation reserve distribution, reduction of capital or of equity, and if the total amount of salaries that the company pays out is less than 85% of the threshold which was paid out in 2019, to that extent also the reconstitution reserve becomes taxable. So it's very important to notice that it's not, you don't lose the entire amount of the reconstitution reserve. It's only to the extent that you do, for instance, a dividend distribution, that it becomes taxable. If you have a reconstitution reserve in 2023 of 500,000, and for that year you do a dividend distribution of 100,000, then only for up to the amount of 100,000, your reconstitution reserve becomes taxable. It's also very important to notice that you can combine the reconstitution reserve, so this tax-exempt reserve, you can combine it with the use of carried forward losses. Carried forward losses you would still have even after the carryback of losses, which is allowed in 2020. To the extent you still have carried forward losses, you may be able not to use them. You can safeguard them and transfer them to a next taxable period, because you will implement for that year, you will record a reconstitution reserve. So you can actually play a little bit with the two measures. Also, you know, in Belgium, any profits above 1 million euros are subject to a minimum taxable base taxation of 30% for any amount exceeding 1 million. So you may lower actually the total threshold of your profits by applying the reconstitution reserve, which means that a certain part which otherwise would exceed 1 million still becomes within the reach of a full compensation with carried forward losses. So that's a handy tool in that respect. So what is the relevance of the reconstitution reserve in an M&A transaction or in a restructuring transaction? Well, it's not a magical tool. It was also not meant to be a magical tool given the budgetary situation of the Belgian Treasury. But still, it can be a very handy tool because it allows you to defer immediate taxation of taxable profits to future periods. So it's a short-term and a medium-term tax planning tool. It gives you flexibility. It's also a way to optimize future deduction of carried forward losses. You can use, if you make, I would say, a tax schedule and you would have a forecast of your future profits or taxable earnings, it can be a tool to modify, to plan together with your carried forward losses, how to optimize and to protect your corporate tax liability. Clearly, it optimizes on a short and medium term your cash flow and solvability, because if you can establish a reconstitution reserve for any of these years, you will pay less corporate taxes. So, of course, your cash flow increases. And last but not least, it's also useful for bridging the required minimum term for tax grouping following an acquisition. In Belgium, the question is always, how do I compensate profits from a target company with costs with my holding company? In this respect, you have a minimum 5 years term which you need to bridge in order to apply tax grouping measures. If you apply the Reconstitution Reserve, of course, you have a kind of a build-up, even if it's only a deferral, but it can help you to reach the 5 years period, after which you can apply the tax grouping and you no longer need this Reconstitution Reserve. So that's an advantage. A disadvantage is perhaps, yes, some financial operations cannot be carried out, like a dividend distribution, reduction of capital. So that is something to see if it really fits into your financial planning to do so and to implement the Reconstitution Reserve. Secondly, I would like to discuss with you some topics related to debt forgiveness. Debt forgiveness is obviously something we often encounter in M&A planning, M&A transactions. It can have various reasons. It can be from a commercial point of view, you want to clean up a company. It can have a tax, of course, it's a means of consolidation from a tax perspective. It's also for restructuring important. You want to optimize the equity position of a group company, so you convert a claim into share capital. So it can have it's a mother with many children, so it can have various reasons. In an M&A context, a debt forgiveness is often part of a post-acquisition restructuring, for example, a consolidation of intra-group claims and debts. From a corporate tax perspective, careful planning and business motivation are required in order to avoid adverse tax consequences. So it's not so that from a corporate tax point of view, it follows financial imperatives or company law restrictions or priorities, and it's neutral from a tax point of view. It doesn't work like that. You can be sanctioned, even heavily sanctioned, if you do it in a manner which is not complying with Belgian tax regulations. And these are some of the points I would like to enter into more detail with you. Which types of debt forgiveness do we generally recognize? Well, you have the intra-group debt forgiveness, which is often the most frequent one, obviously. But it can also be between non-dependent, between independent parties, like you, from a commercial viewpoint, you want to reinforce a long-term relationship with a client, with a customer, with a supplier, so you agree a debt forgiveness. Often the debt forgiveness is also conditional, as they say in French, condition de retour à meilleure fortune. So I forgive you the debt, but only on a suspensive basis. So you don't need to pay back your debt, but as soon as you find yourself in a better position, at that moment, the debt relives, the obligation to pay the debt relives, and I expect your repayment of the debt eventually fully. And then there is also the contribution of claim into share capital or equity. You want to clean up a debt, a claim, for instance, between group companies, well, per definition between group companies. So you say, listen, don't repay the debt, but I will be glad to start participating in your share capital or in your equity. What are the consequences for the creditor? There is a tax consequence for the creditor and for the debtor. For the creditor, well, a debt forgiveness which does not qualify as an abnormal or benevolent advantage is accounting and tax deductible. Abnormal or benevolent, if the debt forgiveness could be considered as abnormal or benevolent, it may lead to adverse tax consequences. So it's a case-by-case assessment. There is no general or precise rule. You need to assess case by case. And the key question is, what would any third party in normal circumstances do in a comparable situation? So that it doesn't mean that it's not allowed between group companies. It is allowed, but the question is, are you doing it for tax purposes, only for tax purposes, or is there also a solid business motive behind it? If it is considered abnormal or benevolent, well, the claim which is forgiven, the amount of the claim forgiven without any business motivation will become taxable, because the accounting deduction you make will be compensated on a tax level by adding a non-allowed expense to your taxable base. So as a creditor, you forgive a claim, you don't get a repayment. Still, from a tax point of view, you are taxed on the amount that you have forgiven if it would appear that you've only done it for tax reasons. For the debtor, well, the debtor obviously realizes an increase in taxable in profit because a certain liability from his balance sheet disappears, which makes that it increases the reserves. If, as a debtor, you enjoy such a debt forgiveness, you can still use carried forward losses. These carried forward losses can compensate the amount of profits, of taxable profits that result from the fact that somebody has forgiven you a debt. However, and again, as a mirror, I would say, as a mirror consequence to what applies to the creditor, if as a debtor a claim is forgiven to you, a debt is forgiven, then you will not be allowed, you will not be permitted to use your carried forward losses to compensate the profit that results from the fact that you were forgiven a claim, if it appears that this debt forgiveness also can be considered as abnormal or benevolent. So this nearly always could be a risk between group-related companies where you want to shift profits or liabilities. If you apply a debt forgiveness without a solid business motive that really sustains that there are other reasons than pure tax reasons, well, in such a case, even if you are in a loss position, you can still be effectively taxed as a debtor, as a beneficiary of such debt forgiveness. You will find on the slides three examples, recent examples of debt forgiveness, which two rulings and one court case. So the ruling of 27 July 2020 was a debt forgiveness was allowed prior to the sale of shares. It was a transaction between non-related companies, but still the ruling allowed the debt forgiveness because the main intention, the main aim of the creditor was to clean up the company before he sold it. We have the ruling of January 22, 2021. There is a debt forgiveness between related companies, and that was a debt forgiveness which was subject to a condition, meaning the improvement of the financial situation of the debtor, of the beneficiary of the debt forgiveness. And the ruling committee ruled in favor of the request, because the main purpose, which was also clearly established, was to reinforce the equity of the subsidiary company of whom the debt was forgiven. And then we have a negative decision by the Court of Ghent of 11 February 2020, which did not allow the tax deduction of the debt forgiveness because the proof it was that the claim was definitely lost was not supplied by the taxpayer. So also there, the economic substance of the operation is really important. So I have come to the end of this short presentation. It's all very technical. Please, however, bear in mind you can download our slides. You will find the information on it. The poll is now opened. So the question the poll is now open. So the question is, I would like to submit to you, does the Reconstitution Reserve become taxable if any of these three conditions or events occur? If the company which has established the Reconstitution Reserve is involved in a tax-free merger, or the company concerned carries out a repurchase of shares, which is a cash out, which is a bit contrary to the aim of the Reconstitution Reserve. Or three, the company concerned uses its carried forward losses. That's a third possible event. The poll is now open. It is running. I'm just waiting for the results. We are collecting the responses. And the large majority of the audience correctly filled in that it's event 2. More than 70% gave the right answer. The company concerned carries out the repurchase of shares, because if the company is involved in a tax-free merger, all the tax characteristics remain intact. And if the company concerned uses its carried forward losses, the Reconstitution Reserve as such remains intact. So, as I explained, you can combine both measures. So, I would say I would like to thank each of you for being so enduring to listen to our, well, technical contributions. These were various topics which we encounter in many dossiers. There are many other topics which we could discuss as well, and which we probably will discuss at one of the future webinars. Many thanks to all of you. Please do not hesitate, if questions remain, if remarks are still there, to address Peter, Florence, or me. You will find our contact data at the slides here, the slides which you can also download. Many thanks to all of you, and I'm saying, and I wish you a very happy and constructive day. Thank you very much.